Welcome to Breaking News to Trading Moves. Today, we're looking at a development in corporate financing that tells us a lot about the current state of the AI infrastructure buildout. You have a single event, a change in a major company's funding status, and we're going to use it to see what it means for the market. Our mission is pretty straightforward. Take the reported facts about this big data center project and figure out which companies might have an advantage now and which might be facing some new challenges, all based on this one financing twist.
It's a great lens to look through. For the last couple of years, it's all been about the tech story, NVIDIA, new AI models, just this incredible demand. But underneath all that, the physical hardware, the buildings, it all requires huge amounts of capital.
And when that capital gets nervous.
Exactly. When the money gets nervous or starts demanding tougher terms, the entire timeline for building out the future of the cloud is put at risk. And that's really the tension we're going to explore.
So the headline event is the shifting financing structure for Oracle's planned $10 billion data center project up in Michigan. This isn't just an Oracle story. It's about the pressure points of scaling AI.
So we'll start with the specifics. The scale of the project, the financial setup, and what exactly happened with the funding. Then we'll zoom out a bit to the broader market context and ask why this one snag is such a good test for AI infrastructure funding globally.
And from there, we'll get right into it, clearly identifying the companies that could benefit and those that are now in a tougher spot because of this. This is where we connect the facts to some real trading considerations for you. All right, let's start with the scale. You said this is a huge project. We're not talking about a small office build here.
Not at all. This was planned as a truly massive build. The investment was pegged at $10 billion for a single data center campus.
$10 billion. What does that kind of number even imply for a data center?
It implies a full-on commitment to competing in AI. It's a mega project by any definition. The plan was for it to exceed 1 gigawatt of operational capacity.
Okay, 1 gigawatt. Can you put that into context for us?
Sure. 1 gigawatt is roughly the output of a standard nuclear power plant. So think about that. An enormous continuous flow of electricity all dedicated to one thing: compute power. The infrastructure you need for that is like powering and cooling a small city.
That really frames the cost and complexity. It's not just servers in a big box.
Yeah.
The power and cooling alone are monumental challenges. And where was this all supposed to happen?
The location they picked is Saline Township, Michigan. And that choice is very deliberate. You see a lot of these hyperscale companies moving away from the established hubs like Northern Virginia or parts of Texas.
Why is that? Power grid issues.
Exactly. The grids there are saturated. Land is incredibly expensive. So places like Michigan, they offer access to relatively robust power grids and much bigger parcels of industrial land you need for a project this size.
So a $10 billion plan, a gigawatt of power, a strategic location. Everything was lining up for the AI race. But then a problem. The core event, as first reported by Reuters, is this change in the financing. What went wrong?
The whole twist is around the riskiest but most essential part of a development deal like this: the equity. These huge projects are almost always funded with a mix of debt and equity.
Debt being the lower risk, lower return part.
Right. It gets paid back first. Equity is the high risk, high potential return slice. It's the capital that absorbs the first losses if things go wrong.
And the players here were Oracle as the tenant, a developer called Related Digital, and then the initial equity backer.
Correct. The original equity backer was Blue Owl Capital, a major player in alternative asset management. And according to the reports, Blue Owl did not move forward on the deal terms for their equity piece. They walked away.
Wow.
Yeah. And that creates an immediate vacuum, a hole in the financing for a very public, very large project that's completely dependent on that kind of project-level financing.
Okay, let's dig into that for a second. An equity backer walking away. If Blue Owl was supposed to be taking on that primary development risk, why would they back out now? I mean, the demand for AI capacity seems almost infinite.
It all comes down to the risk-adjusted return, what they expect to make versus the risk they're taking. The equity investors, they take the first hit if the project goes over budget, or if the timeline gets delayed, or, if the tenant Oracle doesn't meet some lease obligation.
So Blue Owl's withdrawal suggests something in that equation didn't add up for them.
That's the logical conclusion, that after their final review of the contracts, the cost of debt, the construction costs, whatever it was, the expected return just didn't justify the immense risk of a $10 billion 1 gigawatt project. They decided the price was too high for the potential reward.
That really highlights how many moving parts there are. You have Oracle, the end user, who desperately needs this capacity to keep up with Microsoft and Amazon. You have Related Digital, the developer, who needs the capital to even break ground. And you had Blue Owl,
Hmm.
the now departed money.
Precisely. And when a major piece of that puzzle, especially the equity piece, which kind of validates the whole project's risk, just disappears, the entire financing package has to be reevaluated. The debt providers, they often won't even commit their money until the equity is locked down.
Because the equity is their safety cushion.
It's their cushion, exactly. Despite all this, though, Oracle is saying the project is still on track.
What have they actually said publicly? How are they trying to manage the perception of a $10 billion project losing its main equity partner?
Oracle is reporting that the equity deal talks are still on schedule, even with Blue Owl's withdrawal. They and Related Digital are actively looking for a replacement.
But the key thing, I imagine, is that they haven't named one yet.
That's the uncertainty. A new equity backer has not been publicly named. They're basically operating on the assumption that they'll find a replacement quickly and on terms that are good enough to fill that whole Blue Owl left.
And what about the physical timeline? For investors in the supply chain, that start date is everything. Has the actual construction been pushed back?
The current official timeline still points to construction starting in the first quarter of 2026. This is the tightrope Oracle is on. They haven't publicly delayed the build, but the financial foundation for that timeline is now, well, shaky. For investors, this creates a period of real uncertainty between now and that Q1 2026 date.
And they have to weigh the risk that Oracle might have to delay it or maybe even scale it down.
Or put more of their own cash into it, which has its own consequences, all to meet that 2026 target.
Right. So this specific snag in Michigan isn't just about Michigan. It feels like a real-time stress test for the entire tech sector. Why is this particular project such a crucial barometer?
Because it's a live diagnostic of the AI infrastructure financing world right now. For the past couple of years, the story was simple. AI demand is infinite, so funding AI data centers is a sure thing.
A guaranteed win.
Right. Companies like Oracle committed to spending billions, but they don't usually fund these entirely by themselves. They lean heavily on external capital, institutional debt, and equity to spread the risk and build faster. This event with Oracle shows that those investors are not just writing blank checks anymore. They're looking very closely at the terms and the risks.
Let's get into that capital provider friction. This is where it goes from an Oracle story to something that matters for traders. What are the financiers demanding that would make a firm like Blue Owl walk away?
The key element is the rising cost of capital, plus, frankly, more skepticism about the long-term profits. Capital providers, especially these huge equity and debt funds, are demanding tougher lease and debt terms.
It's not like it was a few years ago with near-zero interest rates.
Not at all. Back then, capital was cheap, terms were loose. Today, interest rates are higher, borrowing is more expensive, and investors are asking harder questions about the profitability of these data center leases, which can last 10 or 15 years.
So they're just pushing back on the risk.
Exactly. They're asking the hard questions now. Questions like, is this power purchase agreement actually stable for the next decade? What if our power costs go up 50%? Is Oracle's lease commitment truly ironclad, or are there sneaky opt-out clauses? They want more protection, higher annual returns, tighter financial covenants before they commit billions.
So Blue Owl walking away suggests the proposed terms favored Oracle or the developer more than the equity provider.
That's the implication,
Yeah.
that the risk-reward profile just wasn't there for them under the proposed deal structure.
Okay, but let me play devil's advocate for a moment. Isn't this actually a good sign for Blue Owl's own investors? Doesn't it show they're being disciplined, that they're not just chasing bad deals?
That is a really important point. From a pure portfolio management view, yes, discipline is what you want to see. Blue Owl is signaling that they care more about rigorous underwriting than just getting in on every big AI deal.
But the market perception is different.
In the immediate term, for this specific $10 billion project, the perception is negative. It suggests something is structurally difficult about the deal. It moves the narrative away from AI buildout is easy money to something more like the AI buildout is financially complex and risky. And that caution affects everyone.
So if the big financiers are getting tougher, what are the wider market impacts of this friction? How does it affect project delivery on a global scale?
First, project timelines start to wobble. These mega projects are scheduled down to the day, but when you have to pause to find a new equity partner, that introduces a lot of risk. You can't just assume the money will be there when you need it at the price you want. Even a 6-month delay finding a replacement can cause the whole schedule to slip.
And that slip cascades down to all the contractors and equipment suppliers.
Everyone down the line. It also directly changes the near-term expectations for cloud capacity. The market has been pricing in huge capacity additions from Oracle to compete with Amazon and Microsoft.
But if this massive 1 gigawatt build is now at risk of being delayed,
Investors have to adjust their supply forecast. Capacity they were expecting in, say, 2027 or 2028 might now be viewed with more skepticism, at least until a new backer is found and ground is officially broken. And that, in turn, makes the existing reliable capacity from other providers much more valuable.
which flows right into market sentiment around any stocks that rely on that AI capital expenditure or CapEx.
Absolutely. When financing gets harder, investors immediately start asking, okay, who can actually pull off their ambitious spending plans? This forces a repricing of execution risk. The focus turns to which companies have the strongest balance sheets, tons of cash, high credit ratings, existing relationships with private capital.
And companies relying more on this kind of project-level financing, like Oracle in this case, suddenly look a bit riskier than those who can just fund it themselves.
That's the core of it. The game is now about who has the financial muscle to actually execute in this environment.
All right, let's pivot to the market beneficiaries. This is the trading moves part of our conversation. If there's a perceived delay because of financing, which companies are in a position to pick up that demand or benefit from these tighter capital markets? Let's start with the first group, AI cloud capacity alternatives.
This is the most straightforward group. They win simply because they are already up and running. They have the capacity that Oracle is currently struggling to get the financing for. Any company looking at Oracle's uncertainty now has a very clear, immediate alternative.
The thinking here is that any delay in Oracle's AI rollout just pushes workloads to the platforms that are already established and fully funded. If you need AI compute power today, you go where the servers are already humming.
And that list starts with Microsoft, ticker MSFT. They're already the main partner for so many AI developers through their relationship with OpenAI and their giant Azure cloud platform.
So a hiccup for Oracle makes Azure look even more stable.
It makes Azure look rock solid. Microsoft's scale, their AAA balance sheet, it completely removes the kind of project-level risk we're seeing here. Businesses want platform stability above all else for their AI workloads, and Microsoft offers that in spades. The money that might have gone to Oracle down the line now flows more reliably into Azure usage fees today.
Then you have Amazon, ticker AMZN, the longtime leader with AWS.
Right. Amazon Web Services, or AWS, is the benchmark for enterprise cloud. They have the deepest pockets, the biggest global network of data centers, and a proven track record. When a competitor like Oracle starts to show some financial fragility in their expansion, AWS becomes the default safe harbor.
So enterprises will choose the certainty of an existing AWS region over the promise of a future, unfunded data center in Michigan.
Every time. This uncertainty actually justifies AWS's own aggressive spending because they know the market consolidates around reliability in times like these. Higher utilization of their existing capacity is a direct benefit to Amazon's bottom line.
And the third in this group is Alphabet, ticker GOOGL, with Google Cloud. They're making a big push with their own specialized AI hardware, right? Their tensor processing units.
Yes, Google Cloud is competing hard for AI market share by leveraging their own custom chips and networking. They might not have the same enterprise footprint as AWS, but they are a primary destination for advanced AI researchers and developers who need that very specialized hardware.
So if a potential customer for Oracle's future capacity gets nervous,
Google Cloud is perfectly positioned to capture that specialized, high-margin demand. Again, the perception of execution reliability is key here. Google is well-funded internally, so they gain market confidence when a competitor stumbles on the financing side.
okay, let's move to the second group of winners. Incumbent data center landlords with capacity that's ready to go. This seems to be about the scarcity principle.
It is. When financing for new hyperscale builds gets tricky, the value of high-quality, pre-existing data center space goes up.
How does that supply shock translate into pricing power for these landlords?
The mechanism is a sudden tightening of new supply. Building a new data center takes years, even in the best of times. When a $10 billion project hits a public funding snag, it's a reminder to the whole market that building new capacity is hard, risky, and expensive. This tight supply environment gives pricing power to those who already have buildings up and running. They can get better terms on new leases and renewals.
And the first company here is Equinix, ticker EQIX.
Equinix is a perfect example. They run a massive global network of what are called carrier-neutral facilities. They are the physical meeting points for networks and companies. Because their capacity is already built and operational, any delay in new competitive supply just increases their leverage.
So enterprises will pay a premium for that immediate, reliable, and highly connected capacity.
Which is something a delayed construction site in Michigan simply can't offer. This Oracle situation just reinforces the value of Equinix's existing secure footprint.
Then there's Digital Realty, ticker DLRR. They tend to focus more on the huge footprints that the hyperscalers themselves need.
Yes, Digital Realty specializes in providing the massive campuses needed for these big cloud deployments. Their main challenge is managing their own financing for their own new builds. But if their customers' competitors, like Oracle, are facing financing delays, DLR's existing properties become instantly more valuable. It gives them immediate pricing power and lets them lock in favorable lease terms in a market that's suddenly tighter.
Okay, the third group of winners is maybe a little counterintuitive. Mega cap alternative asset managers.
Right.
How does a funding failure benefit other financiers?
It's all about understanding the capital market dynamics. When a project this big fails to get equity on its initial terms, it forces the developer and the tenant, in this case Oracle, to become more flexible, maybe even a little desperate.
The power shifts to the people with the money.
It does. When financiers start demanding stricter terms, only the largest, best capitalized funds can step into that vacuum. They have longer investment horizons and can afford to be patient.
So the result is that these huge funds can step in and buy that equity position, or maybe a debt position, at a much better price and with better protections than Blue Owl was originally offered.
Exactly. They get to buy in on the cheap or with much stronger contractual safeguards. A great example is Blackstone, ticker BX. They are one of the world's largest asset managers, and they have enormous, flexible pools of capital specifically for long-term infrastructure assets.
So when a deal like this collapses, Blackstone can swoop in.
They have the scale and ability to enter the negotiation, potentially pick up that equity stake at a discount, or structure debt terms that are highly favorable to them. They see that the underlying asset, a huge data center backed by a major company, is sound. It was the financial structure that was the problem, and Blackstone has the expertise and the patient capital to fix that structure in their favor.
And the other name here is KKR, ticker KKRR.
KKR is in a similar position, specializing in complex, structured financing. These mega funds thrive when capital is tight and deals are complex, which is exactly the situation created by Blue Owl's withdrawal.
So they can analyze why Blue Owl walked and then structure a better deal for themselves.
That's the playbook. They can look at a $10 billion project backed by a long-term lease from Oracle and see the distress as an opportunity. They can demand a higher return, maybe 15% instead of 12%, and get more favorable clauses in the contract that protect their investment against construction delays or cost overruns.
Okay, we've covered the beneficiaries. Now let's shift to the other side of the coin. The parties facing potential delays, higher costs, or just more skepticism from investors because of all this funding uncertainty.
Right, the losers. And the first group is the most direct, the companies right at the center of the deal and others whose own spending plans are now under a microscope.
The rationale being that this funding ambiguity creates very real risks. You have delayed capacity, higher financing costs, and just a lot more scrutiny from investors about the whole AI spending story.
And we have to start with Oracle, ticker ORCL. Even though they're sticking to that Q1 2026 construction timeline, losing an equity partner on a project this big is a material issue. It affects their competitive position.
What are the specific risks for Oracle here?
Well, there are a few. First, they might have to commit more of their own cash than they planned, which reduces their financial flexibility for other things. Second, the cost of the replacement equity will almost certainly be higher, which makes the whole data center more expensive and could hurt the profitability of the AI services it will eventually run.
And third, the delay risk itself.
The delay risk is huge. It impacts their ability to compete with Microsoft and Amazon in the near term. Investors now have a very public reason to question the certainty and the timing of their big AI-capex plans.
And what about the other party, Blue Owl Capital, ticker OWL? You said they might have exited for good financial reasons, but the market doesn't necessarily see it that way.
It's a tricky position for them. Blue Owl is now publicly linked to walking away from a massive $10 billion AI infrastructure deal. Internally, it was about discipline. They didn't get the terms they wanted. But the immediate market reaction can still be cautious.
It makes it look like they're more conservative on AI infrastructure risk than their peers, like a Blackstone or KKR.
It could be perceived that way. In a market that's racing to acquire these assets, stepping back from a major one invites scrutiny about their commitment to the whole sector.
Let's move to the next group of losers, the data center power and cooling equipment suppliers. This group faces logistical risk.
Yes. The rationale is that these huge builds are the source of substantial, reliable orders for equipment suppliers. These orders are often booked years out, giving them a really valuable backlog.
And you can't just buy this equipment off the shelf.
Not at all. Think about the physical gear needed for a 1 gigawatt data center. You have switchgear, massive UPS systems, specialized liquid cooling. These things have long manufacturing lead times. Their production is tied directly to the construction schedule.
So if a mega site like this one has a financing reset, the shipment of these big multi-million-dollar orders can easily slip by a quarter or two.
And that slip is what causes the lumpiness in revenue that investors hate. A 3-month delay in construction can mean a 3-month delay in a huge equipment delivery, and that throws off the supplier's revenue recognition for the quarter.
A good example would be Vertiv, ticker VRT.
Yes, Vertiv supplies critical digital infrastructure, especially thermal management and power solutions that are essential for high-density AI. Their stock is closely tied to the expected pace of this hyperscale spending. If a huge project like the Oracle build pauses, it creates a hole in Vertiv's forward revenue visibility. Their backlog is highly valued by investors for its predictability. If that backlog starts to convert to revenue irregularly,
It creates anxiety.
a lot of anxiety. The market hates uncertainty, especially in high-growth stocks like this.
And similarly, Eaton, ticker ETN, which provides a lot of the essential electrical gear.
Eaton faces the same challenge. They're a major supplier of power management systems and switchgear. These components are ordered in massive custom volumes for a $10 billion project. When the construction funding gets unstable, the procurement process freezes. No one wants to take delivery of millions of dollars of electrical gear that's just going to sit on a site with an uncertain future.
So an order they expected to ship in, say, Q3 of 2025, might suddenly move to Q4 or even Q1 of 2026.
And that irregular scheduling makes it much harder for Eaton to manage their own manufacturing and forecast their revenue, which is a major concern for their investors.
Okay, our final group of losers. The companies that physically build these sites, the construction and specialty engineering firms.
Correct. Their operational risk is tied directly to the steady, uninterrupted start of new projects. These firms thrive on a predictable pace of work. They hire people, buy equipment, and schedule their skilled labor based on firm, multi-year project timelines.
And any pause or financing reset creates huge inefficiencies for them, that lumpiness again, which affects their revenue.
If the Michigan project start date is solid for Q1 2026, they're fine. But any ambiguity about that date forces them to hold on to resources and skilled crews, or maybe pass up other work, only to have the Oracle project get delayed anyway. That's the definition of operational risk in the construction world.
So a company like Quanta Services, ticker PWRP.
Exactly. Quanta does the complex utility work connecting a 1 gigawatt data center to the regional power grid. That's a huge undertaking. Their business depends on managing these large projects efficiently. If the Oracle financing issue causes even minor delays in getting permits or starting site prep, it can create major scheduling headaches for Quanta's crews and equipment.
And they have to pay those specialized crews whether they're working or not.
Right, and that inefficiency puts direct pressure on their operating margins.
And finally, EMCOR, ticker EME, which does the complex mechanical and electrical work inside the data centers.
MMQR faces the same exposure. They handle the cooling, the electrical fit-out, all the complex engineering inside the building. Just like Quanta, they need absolute certainty on when to mobilize their teams. If a financing delay suggests the project might stall, EMCOR has a difficult choice to make.
They either absorb the cost of having skilled people and expensive equipment sit idle,
Or they try to reassign those teams to other projects, and in doing so, they could lose their spot on the lucrative Oracle build. Either way, that kind of inefficiency translates directly into lower profitability for them.
So, to summarize the main theme here, the Oracle funding situation really highlights this ongoing tension between the massive demand for AI infrastructure and the increasing scrutiny from capital providers about the financing terms for these giant projects. It's really a question of whether the money can keep pace with the ambition.
We've moved past the easy, low interest rate phase of the AI build-out. The demand for compute is still there, no question. But the financiers, who are the ultimate gatekeepers for those $10 million checks, are now asking much tougher questions about long-term profitability, power stability, and debt covenants. That subtle change in the power dynamic is what creates the list of winners and losers we've discussed today.
So here's a final thought for you to consider, building on what we've reviewed. Reflect on how changes in the debt market, the cost of borrowing, and the contractual demands of lenders are now becoming a primary factor in determining the pace of the AI rollout globally. It's not just about the technology demand anymore. This discussion is not financial advice or a recommendation to buy or sell any security. The contents reviewed here are purely the opinion of the author of the original material.